Understand this and more, let's welcome on board Abneesh Roy, Executive Director at Nuvama Institutional Equities. And Abneesh, hi, good afternoon, and thanks so much for your time. First up, help us understand this 4.5% spike on Asian Paints that we're seeing. Yes, crude prices are marginally lower, but is that the entire reason why the stock is up?
Yeah, good afternoon, and thanks for having me. Yes, good question. So, five key reasons. I think biggest reason is yesterday's Nestle result, which was quite spectacular. In spite of the GST disruption, Nestle started the result season for consumer stocks with a bang. I think that's what extrapolation is having in the minds of investor. That worst of the urban slowdown seems behind. We agree with that. We expect that in spite of Q2 results for Asian Paints and other paint stocks being weak because of very high rains, because if high rains happen, obviously exterior paint becomes very difficult. We expect that in second half, Asian Paints and Berger Paint should be almost 7 to 9% kind of YOY volume growth, which I think is a good number. See, paint is a pent-up demand. Unlike, say, a beer demand or a carbonated demand, which is going away if the water is weak because of high rains. In paint, because of high rains, yes, paint gets delayed. But because of very high rains, there is a water leakage also. The second reason is from a competition point of view, our sense is worst is behind. The new paint companies are becoming more rational. We are seeing Asian Paint becoming very aggressive in terms of market share. If you see the recent Asia Cup which India won in terms of the cricket match, Asian Paints had a very strong presence in the advertising and the in-stadia. And we are seeing the discounting by the new players also reduce. So we are positive on the competition side also.
Okay, so lots of factors at play over here at Asian Paints. Abneesh, apologies, we'll have to slip into a time-bound commercial, but if you don't mind, we'll keep the conversation going on the other side. Just stay on with us and we'll be right back. Let's keep the conversation going around Asian Paints. And remember, Abneesh, last month I'm aware Nuvama met Asian Paints, and the commentary that we saw from there, wherein they're saying that the priority was to protect market share with 18 to 20% EBITDA margin in the medium to long term. How achievable, how sustainable do you think this is, Abneesh, and what is your overall outlook for Asian Paints? And now, what do you believe the management focus will be going ahead?
Yeah, I think Street will first monitor what is the volume and sales growth. Our sense is in H2 we expect because of disposable income increasing for consumer, given GST rate cuts have happened, food inflation and general inflation is at a multi-year low, interest rate cuts have happened, and we expect more interest rate cuts. And there is the income tax rebates, etc. Monsoon has been good sentiment. So our sense is based on all this, we are expecting urban demand recovery, which has been a key challenge for the sector last few quarters. So our sense is Street will not see margins as the number one. Street will first see what is the volume growth, and if Asian Paint can come to high single-digit kind of volume growth, which we think in H2 is possible, FY27 also it's possible. Street will be excited with that, and that's why the re-rating will happen. Yesterday's Nestle results was a good example of that, right? We saw Nestle's margins come down, but if you see in last 3 days, Nestle stock is up more than 10%. So in consumer stocks, the biggest driver for the stock and for the company will be volumes. Coming to a specific question, 18 to 20%, our sense is maybe a slight miss may happen because Asian Paints has spent very high advertising on the Asia Cup cricket. They have been spending a lot on the new advertisement, which has the Deepika Padukone selling the premium end of the paints. I think 10, 20, 30 will miss from the 18 to 20% is not an issue because the gross margin is under control. As you rightly said, crude oil is also at a 5-month low. Titanium dioxide, etc., also not much of a issue. I think higher advertising will be driving the volume growth, which I think will be seen as a positive. 18-20% is not much of a issue. If the company misses it, I don't think that's much of a challenge. But high single-digit volume growth will re-rate the stock further.
Volumes is going to be the next key trigger to watch out for on Asian Paints. And Abneesh, while we have you with us over here, you did speak about Nestle's earnings. Do you believe the rest of the FMCG staples could also follow suit, and maybe we could be surprised by what we see this quarter?
No, not at all. We should not extrapolate Nestle results to other results in Q2. Yes, Q3 it's possible. See, Q2, what has happened, most other staples companies will see the GST disruption of 3 to 4 days easily. because from September 6 to September 22, there was a destocking. In Nestle's case, because it is more urban focused, definitely more fast moving. Food is generally more fast moving, especially in noodles and many other categories of Nestle. The grammage addition is possible. Unlike that, you say in the HPC category, those things are difficult. So the older packaging, etc., was still being used for biscuits, etc. So I think Q2 results will be weak for most FMCG companies. So the stocks could cool off a bit because of that. But I think Q3 will be strong because the GST related impact will be there, the rainfall sentiments improving, the some festival impact will be there, plus the disposable income will increase because of the GST rate cuts. But Q2 will be weak for Colgate and Imami, etc., Varun Beverages, etc., because the rains has been very high and this is impacting some of the summer categories also. So we should not extrapolate Nestle results.
Okay, Abneesh, I really appreciate you joining us on the show and giving us a sense on Asian Paints, Nestle, and of course the rest of the quarter. Here's hoping that Q3 is much better for the segment both of us track. But on that note, we'll wrap it up on this edition of Markets at Noon.